Hi, JJ here with The Art of Value. Well, Joel Greenblatt, one of the greatest investors of our time, of all time, he got over 50% compounding for well over a decade and he's not done yet. He gave an interview recently where he talked about investing, what value investing means to him, and the opportunity that he sees for value investing, the way that he does it, in the coming period. He thinks it's going to way outperform the market, so he explains what he's doing. The interview was with ETF Think Tank, and I'm going to leave a link to the full interview in the description. But right now we're going to look at a clip of what Joel Greenblatt says about how investing's fun to him and how also it's important.
Investing is really a fun career. It's like solving puzzles all the time, which is a lot of fun, but we're not saving lives. And everyone, I think, to some degree needs to understand some investing because, everyone tries to earn a living and it would be nice to know what to do with that money, and you have to save for the future. And so I think it's important to everyone, and it's important to know what you do know and don't know and keep learning.
I wanted to start with that because I think it's a really good description of it being like a puzzle. Investing's like a puzzle and it's fun, but it is important because everybody wants financial security and we save money, but we also need to invest it. So I think that's a really apt description of investing. So let's see what else he has to say. This time he gets asked about what a value stock or what value investing is to him.
Our definition of value is figure out what it's worth, pay less.
I'm just going to cut in here for a quick second because I think that's a really great definition as well. Work out what it's worth and pay less. That is what value investing is in one short sentence. Okay, let's go on.
Cheap is based on valuing a business. It incorporates growth. It incorporates all the elements of what goes into what are the cash flows you're going to get for the next 30, 40 years, which has to incorporate growth. It incorporates the risk of whether those earnings are going to show up or not. That's your discount rate to figure out whether it's going to show. So all those things are incorporated in valuing a business. And so think on our definition of value investing is merely value a business. That's what stocks are. Try to pay less than it's worth. And we try to do it in a bucket. We try to be right on average. So we used to be very selective and have very concentrated portfolios and do deep dives on everything. Now we're sort of in the insurance business on average, trying to do a great job and buying a bucket of stocks that are going to work out over time. And both ways of making money are great. And, they're both full-time jobs. So we've shifted more to running a big research team with a big tech team that balances risk and goes long short and just takes advantage of our valuations.
Okay, there's Joel's longer definition, but also he explains how he invests. When he talked about being focused in the past, owning just a very small group of stocks, that's similar to what Buffett did in the beginning. Years ago, he used to be very concentrated, very, very focused, maybe 5 stocks sometimes or less, but definitely under 10, do a lot of analysis, work out what it's worth and pay less. And that's how he got that 50% compounding. But now he works with a lot more money, which is Buffett has said, the more money that you have, the harder it is to earn a good return. So the way that he does it now, he has a big research team, which we can't do as individual investors, retail investors. He's got a huge team and they analyze basically the whole S&P 500 and every stock and kind of have a big bucket. It's not concentrated, far from it. He's changed with the amount of money that he's investing. Obviously, when you make 50% compounding, a lot of people want to give you money to invest. So he does it a little bit differently now. So next he talks a bit more about how they go about valuing companies. It involves being like a private investor, buying the whole company. So ownership shares of companies, valuing the company as a whole. He starts talking about value investing in relation to momentum investing, how it's so different, and that he thinks value is the better way to go.
Russell or Morningstar have a particular definition, and it may involve low price book, low price sales. And those are merely metrics and don't really mean anything to me, to be honest. Stocks are ownership shares of businesses that we value and try to buy at a discount, like we're private equity investors, and no private equity investor will go buy a whole business because it's selling at a low price to book ratio or low price to sales ratio, or because, momentum was really good this year. Just imagine if I came to you with a real estate investment strategy that says, I'm just going to buy all the houses that went up the most last year. Hopefully you throw me out of your office.
So again, he reiterates that stocks are ownership shares of businesses, not bits of paper, and we don't just buy them because they're going up. Some people do. Momentum investors, he thinks value is the better way to go, and he starts to explain that.
You could have been right for a decade playing that strategy, but ultimately proven wrong. Yeah, I agree. I'm just.
Well, no, I look at it this way. Stocks are not pieces of paper that bounce around that you put Sharpe ratios and Sortinos on. They're ownership shares of businesses that you buy, you value and try to buy at a reasonable or good price. And companies are valued based on their cash flows. over time. What are the cash flows and what are they expected to be on a normalized basis? What are they expected to grow? And that's all value is. And so if you value something and try to buy it at a discount, that's what I call value investing. Growth is a component of value. So, the way Wall Street divides all these categories up mean not that much to me.
He also talks about how growth is a component of value, which Buffett has talked about before, talking about growth and value are joined at the hip. There's really no such thing as value stocks or growth stocks. Growth is part of value, so you have to value, when you're valuing a business, you value that growth as part of it, so that's important to him. A lot of people kind of miss that just talk about this bucket of value stocks where they're not really talking about value investing, they're talking about something different. So I think this next bit's important. He talks about momentum specifically. Momentum has done better than value over the last decade. We could say not maybe for the last year or so much, but for the last decade, people have just rode the momentum in the bull market. But he says, what if it doesn't work for the next few years? What if it doesn't work for 5 years? What then? You're just left with valuing the company. What are the fundamentals of the company? What's the company worth? That is value investing to him. Work out what it's worth, pay less.
But to answer your question about momentum, let's say, and I agree, momentum has worked for 30, 40 years, just so we have decent data about it, not just in this country, but across the globe. Maybe one or two exceptions it hasn't worked, but it works over time. I'm not arguing that point. The point I would argue is that what if it didn't work over the next couple of years? It could be that it works over the long term. You just have to be patient and, hang in there if it didn't work in the next 2 years. Or it could be that, a lot of people know about momentum. It's a crowded and degraded trade. And that's why it doesn't work over the next 2 years. 2 years from now, I would know the answer to that question. However, if I am actually valuing companies like someone who's buying the whole company based on cash flows, and that didn't work for the next 2 years, I'm not going to stop doing it. That's what stocks are. They're ownership shares of businesses that we value and try to buy at a discount. So I'm going to stick with my guns because that's what stocks are. And I made a promise to my students first day of class every year for 23 years. I said, if you do good valuation work, I guarantee the market will agree with you. I just never tell them when. It could be 2 weeks, could be a few years, whatever it might be. But the market eventually gets it right. Anything that's uncertain eventually becomes more certain. The right answer comes out over time. And, it's crisscrossing with value. It's not necessarily going to stay there an exact value and what is value. And obviously the future is uncertain, but the market will recognize, if you do a good job of valuing businesses, the market will recognize that value within a reasonable amount of time. Hopefully, a big chunk of the time in the next 2-3 years. Sometimes you have to wait 3 to 5, but that's generally correct.
I've heard him say some of this before about teaching his students at Columbia Business School, the intellectual home of value investing for a long time, since Ben Graham, Warren Buffett. But he's worked there and he tells his students that if you do good valuation work, you'll be rewarded by the market, but he doesn't tell you when. So he talks about the importance of being patient. Sometimes there has to be patient for a long time, talking about momentum working better over the last decade or more. But he's being patient. He says that the market will recognize your valuation if it's correct in 2 to 3 years, sometimes 3 to 5. And when you think about it, how many people in the last, say, decade or last 5 years have been willing to wait to kind of get paid to be right? 3 to 5 years. People are often impatient. They're not willing to wait that long, say 2-3 years. If it's not happening after 3 years, if your stock that you've chosen isn't doing well, how many people are willing to wait up to 5 years for it to take off or to be paid for that valuation work? And now he starts talking about the value opportunity that he sees right now in value investing over the next few years, how it's such a great opportunity. Very good, in fact. Listen to what he says.
How do you see the opportunity in value investing right now?
Yeah, it's really just starting. Yeah, this is, if you're looking at your screen, this is the website Gotham.com. And we just put this up a few days ago, and this is sort of giving away over $50 million worth of research and construction, in this. And it's actually telling us where we think the market is now based on past history. This is a chart. It's a research portfolio constructed the same way for 30 years. And what we're trying to do effectively is look at the 1,400 largest stocks and buy a portfolio so that our position weighted averages, we have about the least expensive 20% of names. That's really what this portfolio, this research portfolio is designed to do. It has 700 or 800 names, but they're not equally weighted. They're weighted towards the cheapest one. And so it's effectively trying to capture the 20% of the cheapest names. It's updated daily. It's not that the value of businesses change daily, but prices do. So the relationship between price and value changes daily, and it's always skewing towards the cheapest 20%.
So that graph is showing the average 2-year forward return is 61%. So he's saying that it's a very good opportunity, and this is in comparison to history. They've got data going back to 1990. He thinks it's a very good opportunity. It's gone down a little bit since he made this video, which is about a week or two old. It's like in the 50s now, and because the market's gone up a bit, quite a lot for some stocks, but still, he says the opportunity for the cheapest 20% of stocks. And he's talking about good quality stocks, not kind of junk as they've analyzed them, his research team has analyzed them. So the cheapest 20%, he thinks have got a very good opportunity over the coming years.
Right today, what it says is over the last 30 years, we're in the 92nd percentile towards cheap, meaning the market for the 20% cheapest stocks. If you created the same portfolio out of the 1,400 largest, in the same way, and valued stocks in the same way, given our research team and everything else for the last 30 years. Right now, we're in the 92nd percentile towards cheap over those 30 years. We call it the Gotham yield, but it's the free cash flow yield the way we construct it, but we did it the same way over the last 30 years. It's approximately 14% today, meaning we get a 14% free cash flow yield relative to the all-in cost, the enterprise value of the business, meaning the all-in cost of buying the stock plus the debt that you assume when you're buying the stock, pretty similar to the way a private equity firm would invest. And so we can construct this very diversified portfolio of hundreds of names with a position-weighted earnings yield, cash flow yield of 14%. We've only been able to do this 8% of the time over the last 30 years. And when we've been here, the 2-year forward return has averaged approximately 61%.
Again, he says this for this portfolio of hundreds of names, and they look at hundreds, not just a focused few like some value investors and like he used to do. But he says it's in the 92nd percentile towards cheap, which is historically a very good forward opportunity. 61% as this graph shows it when he showed it then at that time. A very good opportunity for value investors for his particular folio. If you're getting value out of this episode so far and watching on YouTube, please hit that like button to help with the algorithm to spread it to more people.
To give you an idea how that compares to the S&P, the S&P's constructed the same way, according to our metrics, in the 28th percentile towards expensive. And when it's been here in the past, 2-year forward returns have averaged 17%, subnormal, but not negative. So, 61% for the value opportunity, the way we constructed it, 17% for the S&P. And that's not a prediction. That's saying when we've been able to construct these portfolios before, this is what's happened over the next 2 years.
So importantly, he compares it to the S&P 500 index, doing it the same way. He says that it's in the 28th percentile towards expensive in comparison to that value opportunity. And that means the forward returns are about 17% rather than that 61 or now in the late 50s. So quite a big disparity between value and the S&P 500 index as a whole. So the opportunity looks good to him. And this is one of the greatest investors of all time. So he's worth listening to about this, I think, just my opinion.
And my answer to those who say, things don't look so good right now. The Fed is raising rates. We're about to hit a recession. Of course, you're able to construct a portfolio that's fairly cheap. And I would say every time over the last 30 years, we've been in the 92nd percentile. It's looked at least as this bad. So it always looks bad when you're able to buy them this cheap.
So he answers this question about the macro, saying that things look so bad. Of course, you can buy stocks cheap. And he says that whenever in the past it's been in the 92nd percentile like this, it's always looked bad. The economy or the macro situation has always looked bad. So that's a part of value investing. Go in when the house is burning down and buy then when everybody else is running away. So he's saying that the macro economy looks bad. It always looks bad, like in 2009, and when the market bottomed, then the economy looked terrible. Things look terrible. He's saying that the opportunity is good. It's not a reason to hold back from buying cheap stocks in that 20% of cheapest good quality stocks anyway.
I'm very excited about the value opportunities, my bottom line. There's a huge dichotomy. I'm not saying it's like, what happened to us in 98, 99, where we're losing money, everybody's making money. And then in 2000, it reversed completely. But I am saying it does rhyme. I'm saying there's a huge dichotomy between the way we perceive value and what the market is paying for.
So next he gives a caveat about it getting cheaper, saying just because it's in the 92nd percentile towards cheap doesn't mean it can't get a lot cheaper still. He gives the example of March 2009, that cheapest part of the market in the last big bear market in the global financial crisis, got to the 100th percentile. So just because it's in the 92nd, there could be another big washout. It could get really, really cheap. So you could go in and buy and it could get cheaper. So you've got to be prepared for that. He's prepared for that, and it could happen.
If I were investing in the stock market, value is an amazing opportunity right now, 92nd percentile. But let me give you a caveat. That is saying that on March 2nd, 2009, our Gotham yield, which is now 14%, 13%, got to 24%. So that's the difference between 92nd percentile and 100th percentile. That's the cheapest it ever got. Okay. The 2-year forward return from there was 178%. So you probably shouldn't be making 90% a year. The pendulum of the market got very cheap. And all I'm saying is the distance between the 92nd and the 99th or 100th percentile is huge. And you would be losing, another 30, 40%. And now the pendulum swung. When it got there, of course, you made 178% over the next 2 years. So for me telling you that we're in the 92nd percentile and the average return over the next 2 years from our research, based on our research, is 61%. If you can close your eyes for 2 years on average, that's what's going to happen. That doesn't mean it's not going to fall 30% from here. And that is the rub. And that's the great news for people like us. The last man standing will be time arbitrage, meaning patience. And patience is in short supply because everyone is looking to make money in the next year or two. And I'm just being patient. I said, our strategy at Gotham is to be patient, just value the companies, where it's going to be trading 2, 3, 4, or 5 years out. Just take a little longer horizon than other people. And I'm not saying it won't fall 20 or 30% from here if market wants to go even more crazy on the downside. I'm saying, historically, over the next couple of years, if you constructed a diversified portfolio of our definition of value, at least based on past history, we have a great opportunity set. And, we're excited about it. That's all.
There you go. He says he's excited about the coming value opportunity more than he has been for a long time. So in this interview here, also talked about a couple of the books that he's written, really good books. I've read them and they're excellent. I'm going to leave a referral link in the description. Thanks very much. If you use those, I get a little bit of commission on that from Amazon.
My first book was You Can Be a Stock Market Genius. Not you too can be a stock market genius. That would be conceited, but everyone calls it that. You Can Be a Stock Market Genius. I wrote that in 1997, and that was about value and special situation investing. I wrote a book called The Little Book That Beats the Market in 2005. The Little Book That Still Beats the Market came out in 2010. I also wrote a book called The Big Secret for the Small Investor that no one bought. And I wrote another book in 2020. So Still Beat the Market came out a while ago, and it just updated the data from the first book. It talked about some of the further research that we did.
You Can Be a Stock Market Genius is aimed kind of at a master's level student. He realized that, and the books are kind of progressively aimed at sort of more beginner investors to help with some of the concepts in value and how to get paid by the market. They're really worth reading. So I'm going to leave that link for you. So if you've got this far in the video, maybe consider subscribing on YouTube if you're watching on YouTube or in your favorite podcast app. And I'll see you again. Thanks for listening or watching.